Welcome to the Pathfinders video series called The Path to Planned Profit. This is part 2 of our series that explains how your company can survive and prosper in the new economy by adopting our Path to Profit model. As we saw in part 1, the Pathfinders map graphically shows the relationship between 4 support systems: new business, operations, organizational structure, and fiscal control and reporting. At Pathfinders, our emphasis is on organizational structure and fiscal control. The twin goals of pre-planned profit and fiscal control are achieved by understanding and implementing the systems described on the Pathfinders map under the Fiscal Control and Reporting Systems heading. The chart of accounts of your company is the financial backbone of your accounting system. The chart of accounts tracks where money comes from and where money goes. The accounts are arranged so that a balance sheet and an income statement are created. The balance sheet represents a picture of the company at a specific time. Banks and other lending institutions use the balance sheet to assess the strength of your company. The income statement represents the financial activity of the company over a period of time. It tracks your financial activity, and these dollars are reflected on the balance sheet. By following the Pathfinders map, we focus our attention on the income statement. By creating a system that controls profitability and steers your company toward increased profit, we increase the strength of your company and of your company's balance sheet. The income statement, which is also called the profit and loss statement, should be arranged so that you can monitor your company's performance toward a planned profit goal. Your accounting system should be arranged to track income by revenue stream. Your accounts should be arranged so that those costs that vary directly with revenue are considered direct costs. Those expenses that are more a function of time should be classified as fixed expenses, also called overhead. Some accounts that will not fit neatly into either direct costs or fixed costs are classified as indirect costs. This classification of accounts allows the creation of valuable control features. Revenue minus costs equals gross margin. Since direct costs vary directly with revenue, the gross margin percentage should be a constant. Your accounting system will track the actual gross margin percentage for you. The question we need to ask is whether the gross margin of each revenue stream measured in the accounting system performs as planned. We look for variances. When the gross margin percentage is better than we expected, we need to act to continue the trend. When the gross margin percentage is less than we planned, we need to find out why and correct it. Designing a profitable plan and then measuring actual performance to that plan provides fiscal control. As you can see, the majority of the company is making around 30% gross margin, but the residential division is only making 10%, and that is why the company is less profitable than it could be. Our how-to guide, The Path to Engineered Profit, gives you sample account classifications for 8 different industries. It contains modifiable spreadsheets, which are the starting point to track the direct costs associated with each revenue stream. Trend analysis is a simple way of reviewing the financial performance of your company over time. We look for trends over the last 3 years, assuming you have the financial data. Reviewing the gross margin percentage over time provides insight into the trends of your company. Tightening up the direct costs or otherwise increasing the gross margin percentage by even a few points will change your company's overall profitability significantly. Trend analysis is used to help set the financial goals for the company for the upcoming year. Using the information from the trend analysis, a basic business formula can be created for the upcoming year. A basic business formula is a simple financial modeling tool projecting your expectations for your company and can be seen as a mini budget. Knowing your cost of goods and services sold allows you to accurately set a price that allows you to cover your costs while ensuring that you make a profit on the transaction. One area of concern is understanding the difference between markup and margin. It is an important distinction. If you buy an item for $1 and sell it for $1.50, you have earned 50 cents. This is a 50% markup because the 50 cents is half of your costs. However, it is not a 50% profit margin. 50 cents is 1/3 of your revenue. Therefore, your profit margin is 33%. When calculating your cost of goods and services to determine your required gross profit margin, you must be sure not to confuse markup with margin. The 17% difference in your profit calculations can be the determining factor of the survival of your business. Once we have determined your accurate cost of goods and services sold, along with the gross margin received for the sale, we can use that gross margin percentage in many ways, one of which is demonstrating the huge impact that waste has on your bottom line. As one example, say an area grocery store has a 1% gross profit margin on common grocery items. You may have been to that grocery store when they were restocking the shelves. It's not uncommon for an employee driving a forklift to take a corner too quickly and have something fall off the pallet and break. Say it was a 6-pack of tomato sauce that cost $10 to buy, and it breaks, so there was a $10 waste. At a profit margin of 1%, you would have to generate additional revenues of $1,000 in order to cover the cost of that $10 waste. Helping you convince your employees of the importance of reducing waste is outlined in Part 5 of this video series. This is the end of Part 2 of the 5-part overview and explanation of the Pathfinders map. In Parts 3 and 4, we discuss several tools that companies use to plan profitability by project or by department. And we discuss how your accounting system can be modified to track your company's progress toward achieving your planned profit by increasing productivity and reducing waste. In Part 5, the focus is on the organizational structure area of the Pathfinders map. We explain how to create an effective and efficient organizational structure that motivates your employees. The objective is to move your company toward a self-directed team management style, where the employees are motivated and working toward common goals. Pathfinders Profit Consultants is an international company with offices in Calgary, Alberta, and Las Vegas, Nevada. We offer on-site consulting services for companies in Western North America. We offer remote consulting using internet telephony and file transfer to work with clients all around the world in a virtual setting. And Pathfinders offers a how-to guide, The Path to Engineered Profit, written by our founding principal, Robert Elliott. Our webpage, www.pathfindersconsultants.com, is a dynamic site where you can sign up for timely information on business profitability, register for a regional seminar, download free tools, access our library database of helpful articles and links. The how-to guide, The Path to Engineered Profit, explains each area of the Pathfinders map. The guide and its associated workbook of spreadsheets for 8 different industries can be downloaded from our website for $60 US, which includes a full hour of remote consulting to help you get started. Come visit us and take your first steps on the path to planned profit.